Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. Here we are into the triple digits for episodes here. We're actually a few in at this point, so really appreciate everybody who's been tuning in, making this possible. We probably don't say that enough. Really appreciate the listeners out there. Make sure to set your timers, clocks, calendars, whatever, to Tuesday morning when these drop, so you can be some of the first listeners out there. But appreciate everybody, and Ryan Nelson's here with me today. And I appreciate you, Ryan. How are you doing today?
I'm doing really well. How about yourself?
You know, can't complain, man. I say that. I feel like I always answer that question like the same. Mm-hmm. I feel like we both do.
Oh, yeah, absolutely.
Like on this one, like it's almost just like cool. It was just muscle memory at this point, too. And like I remember a couple of episodes.
Nobody's tuning in to listen to our
no one really cares how we're doing. They just, let's get to the good stuff here. But I remember a few episodes, I've tried to like mix that up a little bit, and then I just end up like butchering it and going off the rails. And I'm just like, nah, just stick to what I know. Then we'll get to the good stuff. But today's an exciting one. I'm excited for this one here. We're going to talk about Ponzi schemes, explained like what they are, what they aren't. Most people would have probably have heard the term Ponzi scheme before, or they've seen a movie about it, read a book, whatever it might be. People think of it as these quote unquote scams. I don't know if that's too harsh of a description for it here, but I'm hoping you can kind of break down what a Ponzi scam is, Ryan, and what to be aware of, and just what the impacts of it there are.
Yeah, this was a fun one. I did a little research myself on the exact definitions. It was fun to do a little research on this. But so a Ponzi scheme is a fake investment program. So it's going to pretend to generate real profits, but it's actually just paying earlier investors using money from the new investors.
Okay,
right?
Gotcha.
So it's not a real business. There's no real profits. It's just money shifting from one person to another. So you can imagine the entire system can collapse the moment new inflows or new money stops flowing into it. But so where the name came from, so apparently there was a gentleman named Charles Ponzi, and he, became good at his craft in the early 1900s. So he started promising investors these big returns by apparently flipping international postage coupons. There was some deal with, apparently he was saying that you could get these like postage coupons or something and then sell them in the US, and there was some theoretical arbitrage there or something. So anyways, there was no real profit. He simply used, the new deposits to pay earlier investors, but that was the kind of the shtick he was selling to them, right? And so
Oh,
apparently at his peak, he collected basically what would be millions in today's dollars before the scheme fell apart. So he's what Ponzi schemes are named after. So why do these schemes appeal to people? So they promise high returns with low or no risk. Of course, that sounds attractive.
That sounds great. Yeah, sign me up.
Often they can come from a trusted or convincing person. So imagine maybe this Ponzi scheme is, hey, you pay $100 in, you're going to get 50% returns next month and every year thereafter. And I give my $100, and then all of a sudden I get $100 back or $50 back. I get my returns. I'm like, dude, this is crazy. Then I come sell it to you. I'm like, dude, you got to get in on this.
Yeah, you kidding me?
This is great. I've already received some of the money. You know, it's like, and so it can be, convincing now when your friends and family are coming to you to try to convince you to get into the scheme because they've quote unquote seen it work. It can also sound like an exclusive or special offer, getting access to something that other people don't have access to. The earlier investors, they will receive payouts because the newer investors are paying them, right?
Sure.
So on the surface, it can seem or appear legitimate. You can imagine how it could be sort of easy to fall victim to something like that that does appear legitimate, and you're seeing other people see quote unquote success with it, right?
Oh yeah, I feel like you also, like, if somebody was to approach me who's a friend or colleague or family member, and they can show that like short term like growth or opportunity, like I'm like, hey, that's pretty cool. Is this a boat I need to be in? Like, so absolutely having it come from like somebody who's more trusted, because on paper I'm like, I would never fall for one of those. But if like somebody came to me and was like, I just made this much money doing this, like I'd be like, well, I'll look into it.
Sure. Yeah, exactly. And it's funny, we've done, I think, a couple of episodes now on like different scams and stuff, and you'll see a lot of similar things here, like pressure, too good to be true, right? Like there's just different, a lot of similar concepts. But anyway, so how these things actually work behind the scenes, which we've already alluded to. But so the new investor money goes straight to paying earlier investors, right? So the promoter, the person, the schemer, I guess we'll call them, right? They're going to pocket a portion for themselves. But so again, I've mentioned, but there's no real investment activity happening. And so these can only survive as long as new people keep joining, which obviously can only happen for so long. So eventually these are going to collapse. They're going to run out of new investors, and the existing investors may ask for their money back, right? In which case now that person, Ponzi or whatever, it has to come out with more money out of pocket. And so eventually the math is just going to catch up, right? And you can't just keep paying old investors with new investors' money. And so eventually the deposits, the money you have to pay out, will exceed the money you're taking in, and then the Ponzi scheme collapses. So some famous examples are obviously Charles Ponzi that we mentioned earlier, who the name is after. Bernie Madoff is another super popular one that most people are probably familiar with. Alan Stanford is a more recent one that maybe people are familiar with. But so those would be some examples of people you may have heard of who, quote unquote, pulled off a Ponzi scheme. Of course, you can only pull it off so long. It's going to catch up with you. So it caught up with all these people. But so here would be some warning signs. So like you mentioned earlier, of course it never happened to you, but
of course not. Yeah.
But some things to maybe keep an eye on would be returns that seem too high or unrealistically steady. Again, if it sounds too good to be true, it might just be too good to be true, right? So if you're getting steady returns, there's no volatility, and they feel too good to be true, it's like, well, how's that? How is that happening, right? If there's pressure to invest quickly, right? Similar things in our other scam episodes. If there's vague or impossible to understand explanations, so if you don't have a good understanding of how it's working, you probably want to keep digging deeper, right? If there is difficulty to withdraw your money, so if there's like some period where you're getting locked in, or it's not easy to access your funds, this could be a reason why. If the statements themselves, like obviously appear homemade or look inconsistent, right? That'd be a huge red flag. And if there's no independent third-party custodian. So one of the things I talk about with all of our clients here at Alchemy is we work with a third-party custodian. So Alchemy doesn't take custody of any of our clients' money. Right? And that's important. Most consumers don't know to ask that, but it's really important. So Alchemy, we don't have custody of our clients' money. So we can't, they're getting statements directly from, we custody with Charles Schwab. So they're getting statements directly from Charles Schwab. So now they're not just blindly relying on me and Alchemy. In theory, an organization could just create fake statements and say, yeah, your account, you invest $100,000. Well, guess what? Now it's $105,000. Now it's $110,000. Now it's $120,000. As long as you never pull your money out, they can keep getting away with this, right? And so it's nice to have a third party, a Charles Schwab, who has no relationship with Alchemy and no relationship with you in theory. They're just a third party that has now custody of the assets, creating statements saying, no, this is what your actual account balance is. Right. So having an independent third party, I think, is super important.
Oh yeah, that's a big piece of it. Sometimes just having that extra set of eyes on it, it's like, okay, like, and I could almost feel like in a opportunity like this, like you mentioned, like the urgency and stuff too, of if I was to be approached by something like this, like, yeah, let me talk to my financial advisor. No, you got to do it now, kind of thing. Like I feel like that could kind of go hand in hand before you dig too deep into the books with it.
It'd be those same, those the same exact red flags we've talked about on the other episodes. Exactly. So now, how do you protect yourself? So I would say from a financial standpoint, you want to work with a company who's going to use a custodian. So that's going to be, Charles Schwab and Fidelity are the two big custodians.
Okay.
So in theory, if you're working with an investment advisor and they're using a third-party custodian like Charles Schwab or Fidelity, now you know that third party has custody of the assets. You can log into their website, check your account balance anytime you want. The advisor has no influence over what they're stating the account balances are. They're just reporting the actual account balances, right? So that's using a real custodian, third-party independent custodian is important. You can also, like, if we're talking financial advisors specifically, you can, because a lot of these financial frauds or Ponzi schemes are financial advisors. And so one important thing you could do is verify through their regulatory registration. So you can go to FINRA or BrokerCheck. Or FINRA puts on BrokerCheck, and then the SEC has this IAPD website. So you can go to BrokerCheck or the SEC's website, and you can look up the individual advisor and make sure they're licensed.
Sure,
right?
Smart.
See if there's any complaints against them. So you can verify their licensing. You can also ask them questions and require sort of explanations of how your money's being invested, and continue to ask until you gain an understanding. I love the idea. If you can't explain it to your friend, so if you go talk to some Ponzi guy, right, and he's promising you these amazing returns, and you're like, oh, this is fantastic, and he gives you some shtick about how they're generating the returns, and then you go try to explain it to your friend, and you're like, well, it doesn't, I'm not exactly sure, but it's 50% returns. It's like, okay, like you should probably be able to explain it to your friend. If you can't, then you don't have a good enough understanding yet to be investing in it yourself.
Oh yeah, I think about that specifically with, like, sometimes I'll get a daily like email like about financial stuff, and like one of them is like definitely sponsored by a company. They are also like putting like, hey, you can invest right now into this, like before it goes public, do all these. And I remember, I think I messaged you. I was like, hey man, like, does this sounds great? And you're like, like maybe we should do a bit more research into this here. And like looking back on it, like I looked up, it was like an ore mining company or something like that. And they were like, had a way to like get lithium out of the earth quicker. And like this was like a year ago, something like that. And then I looked them up like today, and they had just filed for bankruptcy because it was just like not a legit thing. And I was like, wait a minute, but they had like paid some sponsorship to like show up on like this site or something like that. It was just, but it was funny. I was just thinking about that. I was like, the trust but verify.
Yeah, that's funny. Yeah, I don't even remember that. I thought you were going to tell me they're now like $1 billion company.
No. I would probably, no, I would have told you that right away. But like it was so funny. I was like, wait a minute, nope, they're gone. Like,
yeah, that's funny. But so like I said, those are some of the things to be looking out for and protect yourself against these Ponzi schemes. Now, there's a lot of like financial advisors, investment management companies. There's a lot of companies and organizations. In fact, the vast majority of them out there are legitimate and not Ponzi's, right? So just some things to, again, keep your eyes on. Real advisors are typically not going to custody their clients' assets. So again, Alchemy Wealth Management doesn't take control of any client assets. We're always having a third party take control of the assets. Also, investments fluctuate, right? So all of my clients know, unfortunately, they probably look at their statements, and every once in a while they see the value's down and then they see it's up, right? In real, the reality of markets is some months are good, some months are bad. And that's the nature of investing, right? If you want higher returns, you have to take higher risk. You're going to have more volatility, more fluctuation. And that's not necessarily a bad thing. It just is what it is, right? Also, real sort of advisors are audited and regulated and have certain transparency requirements, obviously all to protect the end consumer, which is great. If any time you're like hearing the word guaranteed, things like that, that's probably a huge red flag. If somebody's guaranteeing,
can't lose,
that's probably a big red flag that you might want to turn around and go explore other solutions, even though guarantees, of course, sound attractive. In the grand scheme of things, it may be a scam or something, right? So the reality is, what you want is like a strong retirement plan. It's not going to require these exotic strategies or these secret shortcuts, right? These flashy bells and whistles. You think like your money should always be held safely at that third-party custodian, not with an individual person or advisory firm. And then your strategy, honestly, it should be boring. It should be consistent. It should be tax efficient. And you want it to be proven over long periods of time. You don't want the flashy, sexy bell and whistle thing. You just want a nice, boring, consistent, tax efficient, proven strategy, right? So in closing, I'd say Ponzi schemes are going to catch those people who are probably chasing those shortcuts. And really a real financial plan is going to protect you from market risk and fraud risk, but it's not going to protect you from those market downturns.
No, I think that's super well said, man. Really well laid out as far as this goes. I feel like I am well versed in that. It also kind of, gives a peek behind the curtain and really humanizes how these things happen too. And I'm like, okay, cool. Like, I mean, maybe you fell for one. Awesome. Like, fool me once. Okay. Like, but maybe don't fool me again. That kind of thing. Like, but just in general, I think it's something to be aware of and an interesting kind of, I learned the origin of it too. So that's awesome, man. So, great, Ryan. We'll go ahead and pause for a break here. We'll be back on the other side of this, and everybody hang tight.
And now, to put the personal in personal finance.
Welcome, everybody. This side of the Fiscal Physical podcast, the personal section here. And Ryan, I got a question for you. And probably as most of some people have been a homeowner in their days, or at least have done some chores growing up. I'm curious to see what your least favorite household chore is. What would you consider that?
Yeah, I don't enjoy
any of them?
Like deep cleaning, like scrubbing type cleaning of like anything. I'm like pretty tidy. I like being tidy, and I always get comments as there's like nothing on my desk at work. I don't like a lot of things on like my dressers or my nightstands, or like I like things being like in their place and nice and tidy. But I just do not love like scrubbing or doing that really like deep type cleaning. What about you?
Oh, I'm right there with you. Like I can pick up, I can clean a room. Cool. Like this is because I can find a place for something, or I can throw it away, or repurpose it in some portion or some way to use it. But when you have to get into like this deep cleaning, like in the past, we've used a house cleaner, which has been great because I don't have to do that. I think it's a great investment if you can.
Heck yeah.
And one of the times I came home and the house cleaner was still there, and the individual was using a toothbrush, like behind like our stove, and I was just like, I don't think I would ever do that. And I do not have a desire to do this, but I'm so glad you're doing that because it looked disgusting back there.
Yeah.
But like the deep cleaning aspect of it is definitely not my favorite. I don't mind taking out like the trash or anything like that. I actually feel like kind of fulfilled and fun with that kind of stuff. But like when you get into those deep cleaning, the mopping, the scrubbing, you move all the furniture so you can vacuum under everything. Like honestly, I just don't really like household chores at all. And it was funny growing up. We had 4 kids, and like my mom we had like our list of chores to do, and like we'd always fight over like who didn't have to like clean the shower. That was like what it was. We're like, we don't want to do that. But anyway, I'm curious to see what's out there. Like, what's your guys' least favorite household chore that you maybe did growing up, do now, try to avoid at all costs now, and your rationale behind that. So please let us know. And as always, please make sure you are sending us those topics you guys want to hear, you want to cover. Hopefully you guys are learning some things out there. I know I am every week that we do these. So appreciate it, Ryan, and I'll let it linger with you for the last part of this.
As always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening. And as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode. And consider leaving us a rating and review on your favorite platform. This helps other listeners like you Find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.